Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for May 9th, 2022. And we are recording this at 1 p.m. Eastern Time, and this is episode number 341. My name is David Kosmeter. I'm the creator of TimingResearch.com, and you should see my screen right now with the charts for today. And today I've arranged for Sunny Harris and Michael Filighera to join us as our guests for today, and the option professor is back to moderate. So I'm going to go ahead and turn it over to him.
Okay, thanks everybody, and thanks for being here. What a big day today in the markets, coming down quite a bit. We have two fantastic guests here, Sunny Harris and Mike Filighera. They're both going to be giving you tremendous information. But right now, what I'd like to do before we get started is, because of what's going on in the market and my experience, I'm just going to try to explain a couple of things that I have been talking about to people for years and years and years. And that is hedging, and also taking advantage or finding a strategy that works for the circumstance you're looking at. Now, anybody who's been getting the newsletters from me, I've been telling you, 9 million ways, to learn about hedging. The market has topped and it's going to be going down. People who've gotten it are pretty happy. Right now, I want to talk real quick about two things that might be appropriate. One is called a replacement trade, and the other is called put selling. And again, I'm going to use Google as an example. Okay, so Google, I'm looking at that ballpark figure at $2,283 a share, so $22.83, which means if you had 100 shares, which is what I'm going to talk about, you're talking about, in terms of dollars, 228,300. Now, this is just an example, and it's not a recommendation. We don't give advice. So again, this is not something to go out and do. I'm showing you for illustrative purposes how it works. Okay, so let's be clear. All right, so you got $228,300 worth of Google right now, based on this example. Again, it's been coming down since 3,100. So if you've had it from 3,100, you're talking about, you've gone from $310,000 down to 228. So, obviously that's a very big negative, and this could have been done a long time ago, but we don't know exactly where any of these things are going. So a replacement trade, is the purpose of it is to try to reduce your cash risk, but keep you in the market so that if the market does rebound, you have a position. But if it's going to go to 1,800, you're not on the train anymore for the entire drop. As far as being in the stock. So give you an example here. If you, at this point, you'd want to look at long-term options. So I'm talking about January of 2024. You're looking to replace the position. So you'd like to have a long-term horizon to give the market time to make a rebound. So if you look at, there's a couple of different ways to go, and I'm just going to explain it briefly. If you went with the $2,300 calls for January of 2024 as a replacement, you'd be looking at a premium of about $450 times 100 would be 45 grand. So you're taking out $228,300 and you're replacing it with a call at 2,300 for about 45 grand. So that's obviously a very large reduction of the cash risk out of pocket. Now, when you have that type of a long-term position, sometimes people will take shorter-term options and sell them against it to try to reduce the cost. Maybe go 20% out of the money, give the market a room for a rebound, but not give it 20% above, which would be about 2,700 on Google in this example. So that goes for about $27. So if you own the long-term call and you're sure and you're selling against it the short-term call, you could bring in $2,700 of premium, and therefore you're reducing the cost of that other one for $450 by the $2,700, and that would go off the board in July. So the idea is you either buy the long-term option, leave it alone, and your risk is limited to the premium, or you start writing shorter-term options against it to bring in cash flow against it. That's one way of replacing a stock position. Another way is to say Google used to be at 3,000 and you think it might go back up there sometime. So you go out to 2024 again and January, and you look at a spread of 2,600 and 3,000. That spread of 2,600 and 3,000, the differential there is about 11,400. And if Google could return to 3,000 or better by January of 2024, that spread could be worth as much as $400, or in terms of one contract, $40,000. And your total risk on it in this example is 11,400. So those are two examples of replacement trades where you're trying to remain in the market, going longer term on your calls, giving the market time to go through this funk, whatever it's going through, if you believe in the company that it's going to be going back up at some point in time. The second thing is, very briefly, is the selling of the puts. You would imagine when the markets are tanking and the VIX is well above 30, that the puts are rather larger than normal, and they are. So you'd have to pick a price you feel comfortable with buying, because when you sell a put, you're agreeing to buy the stock at the strike price. I'm talking about cash secured puts. So you'd have to have the money in your account to buy this, not a margin put, a cash secured put. Okay. Now, 1,800 from my homework looks like a reasonable worst case scenario on Google based on what we're seeing. Okay. So if you sold a put going out 90 days, why 90 days? Because option premiums shrink most rapidly in the last 90 days, using the Black and Scholes model as an example. So if you sold a put at 1,800, you'd bring in $567 right now, $567, which means if Google never dropped to 1,800 and the time ran out, that option would go to zero, and 567 times 100 is $56,700, of which you would retain. If you're put the stock, meaning it goes down to 1,800 or less, and they obviously deliver you stock that you've agreed to buy, you take 1,800 minus your 567, and you're actually buying Google for 1,233. That's not a bad thing to consider at this point either. And also, if you wanted to get a little bit more sophisticated, you could take that premium at 1,800 and use it to buy calls above the market. And then obviously you would have a cost of 1,800 because you wouldn't get a credit for the premium because you spent it on the calls. But if there was a reversal, you would use that cash flow to actually speculate on the calls. Now, that's a lot to bite into. I've been doing this for decades. I've done thousands and thousands of contracts of options. And obviously, this is a second language that I've tried to translate to people in my weekly updates. Obviously, people's sophistications are much different than my own. But if you have information, if you have interest in learning about some of these things, optionprofessor.com can definitely give you the details on it. All right, that's all I had to say. I only ate up a pretty short amount of time. Now let's get into the guests we have today. I just thought it was timely to explain something like that, even if I did it only briefly. Sunny Harris obviously has a tremendous experience as well, a lot of mathematical experience. And so she's with us today. And Sunny, could you just give a quick background on yourself and again, what's going on at Money Mentor?
Oh, pardon me. Yes, I am a mathematician. I became a trader when I was 30 years old and did that because I gave lots and lots of money to money managers, and they lost $75,000 in 3 weeks. And I thought, I can do that badly on my own. So I started learning to trade and have been trading ever since. And I use my proprietary Sunny Bands for all of my trading decisions.
And we're going to definitely get into Sunny Bands a little later in the broadcast. But right now, let's also introduce Michael Filighera. And Michael, a little background on yourself. And again, what's going on at your company?
Sure. Again, I'm Michael Filighera. And my background is that I have been trading since 1979 professionally. And I was an options market maker here on the Pacific Coast Exchange, also on the London Traded Options Exchange, the European Options Exchange in Amsterdam. And then finally, my introduction to electronic trading was via the DTB, which is the German electronic exchange. On my return here to San Francisco, I went back to the Pacific, but then I jumped ship when everything got too slow and everything did go electronic. And since then, I've been set up in my office here in my home, and converted myself to being a day trader and trading futures. And that is what I do now.
Now, both of you guys definitely have a lot of experience, but you also are both doing quite a bit of short-term trading. And of course, in this kind of environment, if you can catch the short-term wave, I mean, there's plenty of opportunities. I mean, today alone, we're down over 100 points on the S&P on an E-mini contract. That's what, $2,500, $5,000. So, you know, there's plenty of juice out there for even for short-term people as well. Let's start out with our base question that we always have, and that is, what do you guys think the market will do between now and Friday? Basically, it looks like we opened here at 4,081 on the S&P, using that as a reference point. Sonny, where do you think we are on Friday?
Looks to me like we're going to still go lower. I called for that last night in my Sunny Side of the Street free newsletter. Said I think Sunny Bands looks like it's going on down.
Okay.
And
your probability on that?
Oh golly, high.
Yeah.
Not 100, but at least 70.
Okay, yeah, it's pretty high. Michael, how are you feeling as far as where we're going to be on Friday, basis the 4081 starting point?
Basis the 4081 starting point lower.
Yeah.
I do feel that the market is going to ebb and flow. I think that we could have some very strong rallies, but the downside is now kicked in. And just in using my own analysis, you know, which is Elliott Wave, we have dropped into the point of recognition, is what it's called. And that's a point where the majority of the market players, whether they're professional, whether retail, whomever, are realizing, oh, we're going down. And points of recognition can happen in both directions. This one just happens to be because the trend is down right now. So I feel that since we're really in the middle of that recognition, that we still have some downside to go. But that does not suggest that we will not get strong bounces in between now and Friday. I just believe that between now and Friday, we will not end up back above 4081.
Yeah. And again, strong bounces have been the rule of thumb here. I mean, we went all the way up to 4631, and that was a heck of a bounce. But talk about a sucker's rally. That was the poster child of a sucker rally.
Actually, the poster child was the day that the Fed announced they're raising at 50.
That was the sister of the sucker rally.
That was the sister.
No, because when you go to 4631 and you blow out all the moving averages and you get that high, that was, you know, because if you were short down at 4,100, you were definitely gone by 4631. If you were short and it only goes up to 4,200 or 4,300, you might be able to hold your water, you know?
I agreed.
Yeah,
I agree.
With regards to things that you're looking at, I mean, we got a inflation print coming, and we've got some Fed speak going on this week. Sonny, is there anything on a basis that you're looking at that might you know, be important, fundamental or technical?
Well, you know, everything goes back to my Sunny Bands. I also use my dynamic moving average histogram, which the dynamic moving average is in the center of the Sunny Bands. And when it, I look for the movement between the two DMA moving averages.
Can you share your screen and put some Sunny Bands up there so people don't think they're just sunglasses or something like that?
Okay, sure.
And then Michael, when you're up, can you switch over to your screen and maybe look at some of the Fibonacci numbers and count some waves for us?
Sure.
All right. So I think that'd be helpful.
Sonny, you should be able to share your screen now.
Yeah.
You see it?
Yep. See, they're not sunglasses after all, are they?
They are not. No.
All right. So you're at the lower end of the band there a little bit. Is that
right down here?
Yeah.
See how we've gone under the DMA is the purple and gold in the middle.
Right.
So we've gone under that. We've hit the lower Sunny Band and bounced.
Right.
But it was repelled by the DMA in the middle.
Right.
Back down to the lower Sunny Band. It's going lower.
Okay.
And if you look at this, if I squeeze that up a little bit.
Yeah.
And then pull that out. Where's the attractor? There. Right there is what I call an attractor. which is where price has been before and
Right.
repelled and, back and forth several times.
Right.
Those are to me called detractors, and that's at 3,900 where we're looking at.
Yeah. Hey, listen, at $100 a morning, you could be there by after lunch, you don't know.
True, it's true.
I mean, if you're long the market and you're on margin, your boss has got to be telling you to cut your risk back, right?
Mm-hmm. Mm-hmm.
And once the word gets out that people have to sell, that's really when you can go to the
That's when
abyss.
we're going to get some big movement.
Yeah, that's when the black hole shows up.
Mhm.
Okay, so that's basically what the bands are showing us, and that's a very good illustration. Now, and you gave us a little bit of a target. If we do break under 4,000, going down to 3,900 ballpark area is certainly
3,900.
not off the table. Do you have any longer term charts that might make those bands even wider, or is that about as
You want
long
to
as
see
you
that
go
on
back?
the weekly?
Yeah, let's look at the weekly and the monthly. Because believe me, when everything is bad on the short term, you got to turn to your longer terms to get any concept.
Yeah.
And so that's your weekly, and that
Let's
looks,
spread this out just a little bit so you can see
Yeah.
it better. And look at that, it's still on the bottom band
yeah,
on a weekly.
yeah. And on the monthly,
And on a monthly, we've got,
Wow.
yeah. See, that's where I'm coming from, the 34,
Okay, so we-
3,700 area. Yeah,
good point. So right here's where
yep. That's where I
Yep.
got it.
right there is the next one. This is
Yeah.
the lower inner band.
3,700, 3,400 using round numbers, that
Mhm.
would be where there might be enough blood in the street to take a look. And as I illustrated,
And
'cause
that's an
you
attraction.
guys,
Look at this.
yeah, you guys have been around the block. You know what I'm talking about selling puts, right?
Yeah,
And when I say cash secured, make that very clear. I'm not talking about doing on margin where if it goes down, you don't have enough money to buy the stock, you're in deep doo-doo. If you
Mhm.
have money to buy the stock and it's a good company that you believe in, then it's just a matter of holding on to it and hoping it will rebound over time.
Yeah.
But those numbers on Google, I thought were pretty attractive. I mean, 90 days out with a $1,200 and change cost basis, nothing, I don't think that's too scary.
No.
Unless unless we're going into some kind of a situation where the credit system is going to be in problems, or something so off the wall, or this guy Putin is going to start firing things all over the place, stuff we don't know.
yeah.
But if we're in just a revalue right now, I mean, basically we're at they're just revaluating the stuff because interest rates are being recalibrated higher and earnings may dry up and we may get some slower growth. If that's all we're doing, then I think the numbers you're talking about there, 3,900, 3,700, 3,400 makes sense. If there's something behind the curtain that is going to shock us, like some kind of a default situation and all the debt that's been created, or Putin is going to be going off the rails, then none of these numbers could be, valid.
Well,
Right.
we'll see what happens when they start talking about his cancer surgery.
Yeah. And maybe that's unhinged him as well. So you don't know.
For
Yeah.
sure, it's unhinged him. Yeah. Sorry.
All right, let's switch over to the Fibonacci stuff with Michael and get a little flavor on that, because I think that might be helpful at this point as well. Can you share yours, Mike?
As soon as David gets me set up.
Oh, I got you.
Yeah, you should be able to now.
Okie dokie. And that's the one I want to set up. So let's put that over there. Okay. So everybody can see my screen.
Yeah, it looks good.
Okay. This is the daily screen on the S&P. And you can see my Elliott. What the most important number on this thing to recognize is this. This is a super cycle third wave completion point. So when we reached that 4808 back in January, it completed an intermediate degree, primary degree, cycle degree, fifth wave, and then on top of it, a super cycle degree, third wave. Where this super cycle degree third wave began was 1932. So let me just put this quickly into context. On the intermediate degree level, we're really just correcting the last year and a half. On the primary degree level, we are correcting from March of 2020. On the cycle level, we are correcting from 2009, from that low. But if we take it up one more, it's much larger. And honestly, I'm not going beyond 2009 right now, because on a super cycle level, what I look for is a trip back to the low of the previous fourth of one lesser degree. And I'll go out to my maximum chart and you'll see it's right there. So ultimately,
Now, this is,
And
I'll just want to stop you. This is very interesting to me because the pink line gives us something of a crash.
yes,
In other words, again, like we were talking, I mean, if we are just repricing and the interest rates are going to go up towards 3 or 4%, and
Right.
the earnings may slow down and the valuations may go to 15 to 1 or something like that on the P
Right.
ratio. And then,
yes,
then we're talking more in the 34, 35, 37, 39 flavor. But if something outside comes in to cause what we would call a meltdown, you think the
Thank you.
2338 number is the one that would be
I
possibly
actually think the
the worst case.
665 number,
Which one?
665, that low of this previous
Oh,
fourth
wow.
is a lot lower. But let me explain, just because you're right.
Yeah, because what would be,
sometimes-
well, one last thing real quick. If we take 4,800 and we take away your 2338,
Yeah,
and then I divide it into 4,800, what type of a correction are we talking about? We're talking about a little over 50%.
yes,
So if we
That's
were going to go
exactly right.
60, if we were going to go 68%, 61%, a fib
Right.
number, then
That fit-
what would we be talking about? More like about $2,000?
well, yeah, okay, so I'll lay this out for you because you're right. If we are dealing with a very large corrective phase, now you got to wrap some time frame around that.
Right.
And the time frame is that I believe that this correction will unfold over the next 10 to 12 years. And
So
during
you're
that,
not a believer 2022, we're going to get a seismic
absolutely
drop.
not, because 2022 is a totally different situation.
Okay, because like I said, there were
2020
some, I'm just referring to other philosophies of the wave structure, et cetera. And some were saying that either A, it's going to be 2022, a very huge drop, and then it's going to be recovery by 2023. And then there's others that saying is that we're going to see a drop and then it's going to be meandering for many years. And
Yeah.
you're basically coming from the school of, I'm looking for meandering for many years.
Not necessarily.
Okay.
Let me fill in that blank real quick for you.
Right.
I am looking for, again, going back to that other chart so that we can see where things are. I'm working a correction right now. This is the intermediate degree that forms the primary degree that forms the cycle degree. So I'm looking for a total ABC structure down, but on this primary degree level. Now I'm feeling that we're in this first leg of it. So I think that first leg of this, what I would call the A wave, is going to end up down here. That's that 2200 number.
Right.
That's just the A wave. Then we get a B wave. Now, just if you don't know what the characteristics and the personality of a B wave is, it's the following. It'll be deceiving. It'll be deceptive. It'll
Right.
just be a rock and roll rally. So you got people saying, well, I'm looking for it to go down there, but I think we recover. Okay, we will, but we certainly are not going to go to new highs.
So the 4,800's off the grid.
For me right now, yes. If it went to 4,800, which it can do, that would suggest that this first leg down isn't going to be 5 waves, it's going to be 3. An ABC down. Then you're going to get a B wave. That could take us up. But if it comes in, if this comes in as 5, which I'm thinking it will, then no. 4,800.
And again, your reason, for people that are not familiar, the reason you're thinking it's 5 ways is that the primary trend has turned to the downside. And when you're in a primary,
Absolutely.
when you're in a primary trend, like we had on the upside, you had
Right.
a 5 wave up because it was an uptrend, but that has
Right.
ended. And now you're in a primary
And
downtrend.
exactly. And your
So,
impulse.
because some people that are not familiar, they don't understand it's 5 waves on the primary trend and then 3 waves against the trend.
Right.
Right.
Right. So the impulse waves, and those are your 5 waves. Your impulse waves are down. The
Mhm.
trend is down. That actually got proven very quickly for me. And then
Right.
it got confirmed on this low. And so what I really do try to just show people or explain things, it's like going down does not necessarily have to be negative. We don't have to be bullish or bearish.
Well, especially if you're
We don't-
short-term trading like you and Sonny are talking about,
It
there's
doesn't
plenty of
make any difference. I
opportunities all
can
the
be a
time.
long,
Yeah.
Steve, I don't disagree with your statement, but you
Yeah.
can be a long-term trader and still not be bullish or bearish and not get upset when the market goes down.
Yeah.
So my point is, it's like, I think if people take a step back and realize that we have been brainwashed to believe that bearish, down market, negative, bad.
Well, it is if
And
you're
so-
buying and holding.
Well, yeah, it is. But why would you buy and hold?
Well,
'Cause
some
that's
people
what-
like to
that's what we
go,
do.
some people like to move to Florida, leave their portfolio in a 60-40 and then catch sandflies off their feet.
Tell you what, isn't it time to change?
Well,
Isn't it
again,
time
but
to
you know,
change how
there's a
people
lot of
think?
people who are retired and changing
I
it in their
understand that.
pass window.
And
you
they
know.
believe in the status quo.
And don't forget the retirement funds and the pension plans and everything else. They're
I
not
get
they're not
that too.
bunny hopping in and out every 5 seconds.
I agree with everything you say. But
Right.
when we get the status quo breaks,
Yeah.
everybody gets freaked out. And then we get the point of recognition, what I'm talking about right now.
Yeah.
This isn't a buy and hold market. This isn't a market. It has changed fundamentally. It has changed because it's going to take a long time to correct the massive rally we've had. And guess what? If we go back to 1932 and look at that massive upside move, it
Right.
contained 2 or 3 crashes, numerous recessions,
Right.
several wars,
Right.
etc. So the thing is, folks, is like all within that very large bull move were a ton of bad things. So again, what's it going to take? It's going to take time for all of this to unfold.
Yeah.
Now, in the process, we have a lot of switching going around and people not willing to accept the reality of what's happening. They want to believe that the Fed's going to come in with QE. Well, my suggestion is really get an understanding of what happens when the Fed puts out too much money too cheaply and just continues to print.
Well, I mean, it could happen, obviously, but what has changed is between 08 and 21, you had 0 interest rates and you had no inflation. And since 2021, we've had higher interest rates and a lot of inflation. So that's the fundamental change.
I don't 100% disagree with what you just said, but what I do disagree with that we didn't have inflation. They hid it.
No, I'm saying we had no inflation between 08
They
and
hid
21, and
They
they could
hid
get
it.
away with free money, but they can't get away with free money when the prices are going up 10%.
And the other thing is, it's like the fact is we did have inflation.
Yeah,
They just decided we as the common folk in this country,
right.
we can't handle the truth. So let's take out fuel and let's take out food.
Yeah.
Hey, we don't have any inflation, so they will
Right.
continue to support this market. What's changed is how people want to feel and what they want to believe. Now, I'm not here to upset anybody's apple cart and change their beliefs. Their beliefs are their own. But I'm just saying you can come in and trade a market and not be bullish or bearish and make a ton of money for your 401k, for your personal self, or whomever. It's just a matter of getting your correct mindset. I'm looking at this going like, I believe we go down. I see that we've already dropped under 4,000 in the S&P.
No, I mean, and like I
Well,
say,
no, I wanna
what
pose
was
a- I-
obvious, 3 months ago is becoming more obvious. And again,
absolutely,
when you
but I wanna pose a quick- I wanna
withdraw liquidity, you obviously are going to have things not go up in price. You know,
I want to pose a question to you. I think the last time we were on, we were discussing 4,100. Rock hard, solid support. Boom, boom, boom.
I
I
know
went
about
back
rock
and checked.
solid, but it was support. Yeah.
The way it was presented to the world, rock
Yeah.
solid, not going to go through. And
Right.
what happened every time they did, the market made sure lickety split to go back,
Right.
get it back above it. Then it did it again, lickety split, get back and go above it. Now it's trying to just lickety split, stay above 4,000. It's all illusion. Someone's trying to give you a false image of what's really happening.
Yeah, I know.
And
Like I
that's the
say, though, I
part.
mean, it's just because you wouldn't have much airtime on TV if you just went on there and say,
I'm not
Fed is
looking to
ra-
sell
raise-
airtime. I'm
I'm just
looking to tell
saying
the truth.
if they went on TV and said the Fed is raising interest rates, valuations are going to contract, and the prices are going to be lower, tune in next week. They need to put more on. So that's why, you're not getting good information there. But my question is this is a very important question. And then Sonny, I'm going to go right over to you, but I want to ask you the same question. There is a very large prevailing opinion that after this CPI report and sometime after May 15th, there's going to be a very, very substantial run up in the markets because there's not much news after about this week. And ergo, the potential for short covering is going to be there. And we could go up as much as to 40, let's call it 43 or 4,400. Now, Michael, on your graphs, what would start indicating that that might be occurring? So in other words, let's look at your numbers on Fibonacci and the waves. And, obviously we're very much down at a point where, it's oversold. I mean, the VIX is up at 35 again. So unless we're going to break 40 and go into the abyss, this is an area where it might bounce from. So let's let the people.
It can bounce. But here's, first of all,
like I say, we both know that if good news occurs when the VIX is at 35 and we're at 4,000 on the S&P, you could get a very big face ripper rally. I mean, I think we're all old enough to know that that's very possible. My question to you is rather than speculate, by what they call spitballing, let's look at the numbers and what numbers would start indicating to you that the turn may be happening on a short-term basis.
On a short-term basis, and I'm on my daily chart. The first thing it's got to do is it's got to get above the 50-day moving average, which right now is at 41.51.
Okay, so we're going to have to look at a monthly. We're going to have to look at a monthly or a shorter term chart.
Well, a daily takes us through May 15th. You're talking this is going to happen in a week.
Well, I'm talking about in the next where are we at now? We're at the 9th,
May 10th.
In the next 21 days.
In the next 21 days.
So then obviously you wouldn't look at a 1-year graph or a 5-year graph. We're going to look at either a 1 day, a 5 day, and a 1 month.
I can go to the hourly chart. The hourly chart, same deal. It's got to break. In fact, to get up to 43, can it do it? Yes. But you know what's going to do it? Spreading false narratives.
Well, I mean, who cares how it gets there? Let's talk about what number would be an indicator. And I'm going to ask Sonny the same thing with the Sonny bands. But like right now, would 40
it has to break above and not stop.
I'm talking about when's the first sign that it might be turning? When's the first sign? I don't want to.
This is the first, in me, on my hourly chart, a break above the 200 moving average at 4,100, 4,180.
Well, that's way. There'll be a sign way before that on maybe the 5 day. Let's look at the 5 day chart or the 1 month chart.
No, not even on the 1 month. It's even going to be higher. I took it down to where I'll go to let's go to the monthly chart. There's your monthly chart. This thing right now, the 200 is way below, the 50 is way below. So what it has to do here, first of all, it'd have to break above the 20. Oh, sorry, that just switched around. Well, that's because I think it has to break above the 20. That's on my monthly chart. Guess where it is? 40.83. Where was the other one? Where was the other one? 40.81. So
my work was showing around 42.17 to 42.50 would be possibly
17 actually is also there because that's there you go. 20 is below, but that would be the 4.
Right.
The 4 moving up. So that's also in the picture, but it cannot look back. That's my point. It cannot look back.
Oh, no. Like I say, once it turns, it's got to be the end of it. Yeah.
Right. And so, and then here's what they don't put in. What happens when it gets to 43?
Oh, well, I mean, this is neither here nor there. If you did a trade like that, you would be running like a thief in the night and grab your money.
Yeah. Okay.
Yeah, no, we're talking about something that is called a trade potential. And we're talking about something that could be very quick and violent, like a short covering rally. And again, what kind of numbers might have to be seen for us to start seeing something like that?
I think what traders hopefully can do is not be dependent on pundits, on the what ifs.
Oh yeah, that's why we're looking at your charts.
I agree with you, Jim. But
your hard number was around 40.80.
What I want to add, anybody could study and do this same work. And
Yeah.
then you have your own picture, your own levels,
Yeah.
your own process.
Exactly. So if you hear something that, hey, I'm thinking that this could happen after the 15th because
Sure.
the calendar runs dry, Tom, Dick, and Harry will have sold. It's been 9-1 on the downside volume. The VIX is back at 35. If we're not going to go into the abyss, that means we're not going to 40. And ergo, if the calendar drives up and there's some talk of something that's positive, you got a very much of a down market here that has obviously going to have a tremendous amount of people out or short. And that
Yeah.
sometimes is a recipe for a very strong counter rally. And all I was asking is what kind of numbers on your material here would give us an
Well,
indication that might even be starting.
I don't disagree with what you said, but let me just put in a statement. First of all, I would not be looking for something that big. I do think we may be coming into a low, and I think the 15th works as far as you want to pick a number on a calendar, that could work, but it is not going to be a large one. It will seem like it is. It will bounce strongly. On the S&P. We may rally 100 points, and that's a strong rally for the S&P.
Right.
But it's going to be in a minor fourth wave, and that I believe only comes in after we've gotten down to 3,700. Then we will be nice and oversold. We will be oversold, and we will be due a bounce. And then and you can add all the rest of the fluff to it that's going to push people to go run after it and participate.
Just
But
referring back to your graph here, and my whole point
sir.
here is that back in March, we were obviously in the abyss again, and all of a sudden it got above 42.16, and that was kind of your indication that the tide was turning. And then within a very short time, you had a 400-point move to the upside.
And do you remember what was laying underneath it?
Well, it doesn't matter. I'm just talking about the technicals. Now, the second thing is we obviously are totally bent to the downside right now. And so I'm looking at a blue line here at about 4,100.
That's the 20.
And then I'm looking at a yellow at 4,150. So if we started getting above 4,100 and 4,150, and you were a speculator, and you had some belief that these, shall we say, touts are right about this, then that might be a couple of indicators that the tide might be turning, not unlike it was in March when it got above the blue line and the yellow line.
I would say enter at your own risk, but I don't disagree with you. I don't disagree with what you're saying.
So those aren't bad numbers to keep an eye on, 4,100 and 4,150.
But don't forget, they're going to change, Jim.
Oh, yeah.
Change.
And they'll be getting low, and they'll be getting lower as the market stays down here.
Yes. Well, they'll get lower as the market continues to go down. If they stay here, I would not suspect that they're going to go lower. I would suspect the 50 and the 200 go flat.
So if Thursday or Friday, Wednesday, Thursday, or Friday, after the CPI report comes out or some other data, if we were trading 4,100, 4,150 or better, and you were a believer that there was going to be this type of end of the month rally, that might be a little bit of price evidence that it could be starting.
Could be. Yes.
Okay. All right, Sonny, you've heard me and Michael go back and forth on this. How about the Sunny bands? Tell us what the Sunny bands.
I don't know if I want to talk for now.
Well, there's a lot to cover with Michael because he's got the Fibonacci's and he also has got the Elliott wave, and so I wanted to get to
and
all
Michael,
that.
what program, what software is this?
That does what?
Numbers to Elliott waves.
Michael Filighera.
Those are text labels.
Yes.
No, he's got a proprietary thing that he's working with.
Okay.
No, I do not. Those are my labels, and I put them in myself.
Oh, okay.
All right, beautiful. Just wanted to know if you had an automatic generator.
No, I do not.
Cool.
It's me. My automatic generator is me.
Okay, thank you. As far as
let's switch our screen. Let's switch our screen back over to the Sunny Band stuff so we can get your analysis, because that's the beauty of having more than one speaker, is obviously everyone's got a little bit of a different vantage point.
Okay, I've got several things on this chart. I've got the Sunny bands, which everybody I think now knows what those are, the green bands and teal. The DMA is pointing down, purple's on top. You can see down at the bottom, it shows me purple's on top. Right back here on this red vertical line is where I got a short signal. Right there. So it's a little bit off the top of that swing, but it's been short ever since. So it's still short there.
Sure.
Pretty good call on that one. I think, you see how this trend line, orange trend line coming down here
Right.
meets this horizontal line right there. That looks
Mhm.
like that to me, that's about 3 days away from hitting 3,900.
And now these bands, they'll be changing once it gets to 3,900. So they'll be obviously
Oh,
they'll be pointing even lower at that point.
If that happens, they will definitely be pointing lower.
And as far as the first signal, would it be that dark green line that the red bar is pressing right now? That's the first.
Sign we're
that was-
going short, lower, or sign we're
Well, I
going
mean,
up?
the sign of it possibly getting better would be, say it broke to 3,900 as an
Mhm.
example. And then the green line comes in right now at about what, 4,018?
Mhm.
4,015. So say in a couple of days, it might be at 4,000 or 3,975. If it started getting above that, that might be an indicator to you that it might be making a turn.
Well, technically what would have to happen is be for it to break this lower inner band, the teal one. So
Gotcha.
if it's going to come down like this, down, down, down,
Right.
it's going to have to go back up and through that inner band for me to
Right.
think we're going up. But look
And
here, I went through the inner band, went up. Sure enough, that's a good call. And then it turned right around and erased it all right back down to the blue band.
Mhm.
Now
And
let's
it-
again, if we look at I'm looking at another example of a bear market rally, which would be in
Mhm.
March. So why don't we look at the sunny bands and how it gave us an indicator in March that a turn was going, and see if there's
What's that?
anything.
March 31st, it went bearish, right?
No, I'm
There.
talking about where it went from 4,100 to 4,600. That's the kind of thing we're kind of seeing if there's a potential.
Oh, back here?
No,
March
that would have been
14th.
February 24th is actually the date that it started.
Yes.
February. Okay, there you go.
I'll
Yeah.
actually go a little bit more. It's the next low.
Yeah.
To the right there. March
All right,
8th. Okay.
So 3-8.
Yeah, that's what I thought. It was a March rally, right?
Yes, it was.
Yeah. And
Okay, so it got above the
sunny
top,
bands.
it got above the top band there, the secondary band that you were talking
Right
about.
above this one.
And you say that is really the more reasonable signal because it's gotten out of that lower band and it's gone to the
Mhm.
higher band.
Mhm.
And so once it starts going to the higher band, there's a reasonable statement that something might be turning.
Yeah, and
Mhm.
one of the things that we can do with these bands, I've got analysis commentary turned on. So you can see what the current close is, open, high, close range of this bar, the values for the upper inner, lower inner, upper outer, and lower outer, the midline value and the angle at which price is currently moving, and how much up or down it was for yesterday. So all the information I want to know is right here on this one screen. And all I have to do to get it for any bar I want to is here to click on that bar. And there it erased all the sunny bands up to that point. It's great for walk forward testing.
Mm-hmm.
And you can see here, it's all the new values for that one. And I changed the color. There's a blue bar. And you'll see that the close was up. So it changes colors to green. So that's cool because it gives me all the information I need to write sunny side of the street. And it tells me what the difference between the upper and lower bands, I call it diff inner and diff outer. So
Mhm.
it tells me there's a spread of 323 points from this blue to that blue. And 500 and where's diff outer? 523. So 323 and 523. So if you went from this green band to that green band,
Mm-hmm.
that's 500 points. So you can tell if it started, we've got a good rally in store.
Well, that's what I'm trying to put some attention on because people out there, are probably trying to figure out if we're going to go into the abyss, meaning we're going to go down to 3,900, 3,700, 3,400 right away, or because we've had such aggressive selling on a short-term basis. And there are some who believe that the second half of the month may give us a little bit of a rebound rally. what prices would kind of give us an indication that, obviously you want to have some momentum your way. You don't want to just step in front of a freight train.
Yeah, well, it looks like 41.16 where I've drawn this attractor. If
Yeah.
we go above that, that would probably trigger the lines to turn down here on the histogram.
Yeah. And that is in line with what Michael was saying around 4,100 or 4,150.
Mhm.
But if you look at this chart on a monthly, the monthly
Excuse me.
view of the E-mini,
Mm-hmm.
it doesn't look like it's moved very far down at all.
Mhm.
That's not that scary.
No.
So I'm with Michael in if it's going to go down, it's going to go down a lot further than just there, because that little monthly chart's not scary.
Yeah. No, and that
Mhm.
VIX is not scary at 35, but put it at 50 or 70, you'll get your attention, right?
Jim, do you remember the days when 35 was scary?
Well, that's true too.
Isn't it?
That's
Isn't,
Yeah.
no, but isn't it amazing how attitudes can change? Oh, 35, no scary.
Well,
I want
and
to-
last year we never got more than a 6% correction.
Exactly.
That is so weird.
Exactly.
People don't understand. If you've been in it for 30, 40 years, that is very weird, particularly when rates are at this level. And what a
Yes.
talk about a sea change. We've gone from 0.31 on the 10-year to 3.25 almost. And that is, how many times higher?
And they're looking for QE 27 or whatever number you want to use. They think the
Yeah.
Fed should start easing.
Yeah.
I have heard that talked about. I'm
Well,
like,
I mean, again, that's what people are going to be pounding the drum. But again, the Fed already saw what too much printing has done at this kind of level.
we
There's so
hope.
many variables out there, though. All of a
Yes,
sudden, how the
yes.
world is. We have no oil, right? No oil. Next thing you know, there'll be a ton of oil. I mean,
Right.
in March of 2020, we were minus $37 a barrel. I was trying to tell everybody who'd listen that, look at all those cars out there, and they're not making any oil because they're all running out of money. Occidental Petroleum's almost bankrupt. Their long-term bonds are paying 35% interest. So the
Wow,
bottom
yeah.
line is we went from that to where Occidental Petroleum is now the poster child of a great company.
Right.
So
Oh,
you
yeah.
don't think there's a circumstances where they could roll over oil by either the war gets settled out or the producers start producing. Same thing with agriculture. All of a sudden there's absolutely no grain. But then I noticed Brazil is planting more than ever before. So we go
Good
from
news
where we
for
have
us.
we have none of this stuff and we'll never have any of this stuff to
Yeah.
it's all over the place.
Right. No, that a very, very valid point. And I think that's why earlier I was like, I think that we need as traders that external input. It can be more destructive than it can be as helpful. I don't deny for 1 second that the market will rally. I am looking for that rally, but I need to finish this particular wave pattern that's in progress. And because of the study that I've done with Elliott Wave, it allows me to say it's not going to be as big as somebody just tossed a number out there. And if it does, and if it is, well, then it makes me reverse and go back to look at all of the work that I've done up to that point to see where maybe there could be a change.
Yeah.
But I do see the rally. But it's nothing more than just a recovery, a bounce.
Oh yeah, that's what we're talking about here.
Yeah.
Yeah.
But you and I know that.
Yeah.
But it's trying to make to allow other people. It's just like what I'm watching all money come in today. But then I
Yeah.
realized, oh, here we are. We're Tuesday of the second working week in May.
Yeah.
Oh, what happens? 401ks, the money's been delivered. It's been sent over to the funds, put it to work. It's still that same basis where they're not looking to redeem it and take it out and put it somewhere else. They're continuing to put it into the market because, hey, I'm in it for the long haul and this is my 401k and I'm going to retire with it.
Yeah. And Sonny,
so-
you're very much math oriented. I see you have a number up there of 3408 as one of your numbers where the lines come in. And all you got to do is take $2.30 of earnings and multiply by 15 rather than 17. And you're at 3,450 on the S&P. So these numbers aren't pulled out of the air.
Well, this 3408, you'll see it's green. It matches this green band right here.
Yeah. So in other words, and that corresponds to something real, though. You see, you have
Yes.
X amount of earnings on the S&P. And if they give you a 22 to 1 PE ratio, then obviously 2.3 times 22, it gives you 5,000 on the S&P,
Mhm.
you know, but if they are
And
contracting if they're-
4986 is where the top band is currently.
there you go. So the bottom line is, you know, these numbers do correlate to real numbers, which is the
Mhm.
actual earnings the companies get. Because at the end of the
Mhm.
day, when you buy common stock, you're betting on future earnings.
Right. Perfect.
You
Perfectly
know?
stated.
And
my
then of
friend.
course,
True.
you're also betting on valuations. And, you know, some of the more bullish guys, like this guy from Bank of Montreal talking about 5,300 and some of these other guys, they are obviously looking for two things. They're looking for no bump in earnings, meaning the 230 is going to get higher from there. And they're also looking for valuations to snap back up, not go back down.
Right.
It takes more than one person to have a horse race. They could be correct. And you know, and the world
Yeah,
is
they could.
round. The world is round. So, you know, the things that go around come around, right?
That's true. There you go.
We got a few
agree.
minutes left, and I'd love to just do one last market because it might be rolling over in a big way. And let's look at gold.
Oh, I knew you're going to go to my favorite.
Well, you know, it's either going to hold this 1800 mark or you're going to stick a fork in it.
Whose
Right.
monitor are we on now?
Yours.
We're on yours.
too.
So you're
Okay.
going to look at the price of gold. Is that gold? Yeah.
This is gold.
Oh, yeah, good. That's the COMEX.
Monthly. You see it's
Yeah.
monthly.
Yeah.
The tractors obviously are right here.
Yeah, we're
See
on the
how-
ledge.
Yeah, we are.
Okay.
It's a sad story, but yes, we are.
Yeah.
So there's that one there to overcome. Right now, the DMA is here, and right there is the attractor as it goes across left and right. So it looks to me like we're going to go back down to that attractor. I'm hoping at that point that we bounce and come up to the 2141 level.
Yeah.
Yeah. Yeah.
But I was, back in here, I was saying 2000's coming, 2000's coming, and everybody's like, yeah, Chicken Little. So it
Chicken
got
Little.
there.
You know, the
Not
key is,
there.
are we going to have a deflationary deal? And, you know, my son works at a bank and, you know, there's nobody buying a bunch of houses right now. And the mortgage apps and the home sales are totally drying up. So this
Yeah.
25% jump in real estate, that's going to take a whack. And the commodities, you know, we're not at $18 beans, we're at 15 and change, and oil was at 131
Right.
and now it's struggling to
Right.
hold on to 100. So if we
Right.
do go into a deflationary deal here, which is probably the best bet on the board, the gold may have a rough racket holding these higher prices, wouldn't it?
Yeah.
I would agree.
So we've got crude right now at 102 something.
Yeah.
Right.
I just
You can
thought I
see
would
the
bounce over there.
131's kind of off the table a little bit.
Shall I?
As long as it stays between those two bands, it's going to keep going up.
Still, yeah, like I say, it has not broken yet, but you know.
Would you like the Elliott view of gold?
Yes. Yes.
Yeah, let's take a look at that.
It's no, Jim, you and I have been talking about this, and it's the same. It's
Mm-hmm.
that, yes, on a longer term basis, I'm looking for 2,300 to 3,000. And I can give you some information that would force it to that level.
Well,
But
let's
it
switch
hasn't-
over to your chart real quick before we run out of time and plead your
Okay.
case. Plead your case here.
Okay, so we got it. So what we have is, there was the, oops, get the right mouse. There is the all-time high, 2089.
Mhm.
Then we go down and then a wave. So this actually completed, and I go up a little bit, a primary third wave. So we're looking for a primary fourth wave. It's going to take time. Where now it's kind of showing up to be a flat. You know, in other words, this down, that up almost equals that high. So I'm looking for the low to come back down to here. Guess where it says? Just at the 200. This is the weekly 200 moving average, which is at 1679. Now, granted, that's going to shake up a lot of gold traders, but when I look at the long-term picture, it isn't that much. And if I were trading this and had, which I've always had all my life, you know, long-term gold, I would just be putting puts underneath my physical, and not actually my futures position, and ride it out. Because I don't see gold hanging out and just dropping out of the sky. because we have, like you've mentioned, Jim, too many other factors. It's just sitting there without much attention. And I think a lot of the folks that are reeling about it don't want the attention thrown there.
Do you think it
But-
could be a deal like in March where your stochastics got very oversold and they broke underneath the yellow line temporarily? Do you think it
Yeah.
could be a deal like that?
Yeah, I think it could be quick, because what happens? I mean, we're looking at gold today. Suddenly, it's down $27, $30. When
Yeah.
you start getting to that on a single day, that's a pretty good move in gold.
Oh, yeah.
But the other day was like down 50. We're
Right.
like, wow, that's even a more impressive move in gold.
Yeah.
But what it is, it's the whole crowd that they get into the dollar denominated in gold versus the euro. What's going on there? And I agree that all has a place in trading, because it's how you're going to put your trade in and all of that good stuff. But in terms of the Elliott doesn't know anything about any of those fundamentals
No.
or even of the other things. It's a purely technical tool. Right now, it is sitting and desperately trying to hold right here.
Yeah,
At
and it's
40,
in
at
also,
the 53.
very interesting though, Michael, also is the March rally from that area also corresponded to a very sharp rally in the stock market. So if in fact the second half of May is going to see a substantial turn and run up in the stock market, it might
Right.
coincide to the gold turning back up as well.
It could, but actually this rally, you're right, it did concur with the
March.
equity. Yep, that's
Yeah.
March 7th. It does concur exactly.
Yeah.
But from what my understanding of that was, it was somebody getting stuck short. And it's the old adage, Jim, where there are far more derivatives outstanding to deliver gold than exist in
Right.
gold.
All right, we're at
So
the
it's
top
not-
of the hour real quick, Michael. I'm going to basically start with you and then go over to Sonny. We obviously have shown a lot of data here and a lot of data that could be very helpful to people. So
Right.
can you explain how they can get a hold of you and how you could share this data with them on an ongoing basis?
Absolutely. You can always contact me, Michael at MJF1 Partners, and it's the number 1, partners.com. I answer all my emails if you've got legit questions. I'm also, and I need to jump over this right quick here. I have a week-long bunch of workshops and trading sessions. So there'll be a total of 12 hours of trading sessions. It is not real expensive. It's a $97 for the entire week. And you're going to get trade setups, which don't require an indicator. So it's pure trade setups, price action setups. And you're going to get 12 hours of trade time, and that's teaching and learning and being able to ask questions. David hopefully will be able to put that link in there. And again, contact me just send me an email. I'd be more
Sounds
than
good.
happy to talk and to go forward.
Perfect. Sonny, how can people get a hold of you and also get more information on Sonny Bands and the other stuff that you're doing?
Well, everything I know is on my website, www.moneymentor.com. And you can see Sonny Bands there. You can sign up for a free trial of it if you're interested in that. What else is there? References to everything you can imagine. Anything you want, you can find through the references section. And then again, at the top of my website, it gives my phone number for anybody who wants to call. And my email is Sunny, SUNNY @moneymentor.com.
Perfect. Thank you guys for being here. As far as Option Professor is concerned, early in the broadcast, I talked about replacing stock positions down here with limited risk option strategies going out till 2024. And I also discussed how cash secured put writing might be appropriate in some stocks and in some circumstances. So optionprofessor.com, you put your information in there and we'll get you details on that as well. Thanks a lot, guys. I think we covered an awful lot and hopefully we brought some stuff to the table. There's other questions. If you have any questions out there that weren't hit, contact us by the email addresses that you've got there. Right now, I'm going to turn it back over to David. Thanks everybody for being here and good luck and good trading.
Thank you. Thank you both.
All right. Yeah, a lot of good info covered today. So just a quick reminder to everyone, please be sure to subscribe to Timing Research on YouTube and your favorite podcast app. And you can also just go to TimingResearch.com and there's a archive post there that will become the archive for today as soon as I can get the recording posted. So just want to thank my guests again for today. Sunny Harris of moneymentor.com, Michael Filighera of logicalsignals.com, and the Option Professor of optionprofessor.com. Thanks, everyone.
Thank you, David.